Some breaking news. The federal government is starting to take notice of the SVB fallout. Kayla Tausche joins us with the story. Kayla, what's happening?
Well, Kelly, Treasury Secretary Janet Yellen convened financial regulators this afternoon specifically to discuss the situation around Silicon Valley Bank. In a statement that we just got from Treasury, Janet Yellen, the Treasury Secretary, said that she met with the Federal Reserve, the FDIC, and the Office of the Comptroller of the Currency, and said that she has full confidence in regulators to take appropriate actions around the bank, that the banking system, in her words, remains resilient, and that regulators have effective tools to deal with this situation. It comes just a few hours after she appeared on Capitol Hill and went out of her way to tell lawmakers while testifying on the federal budget that she knows that the Treasury Department is monitoring the situation at SVB. They're monitoring it closely, but that at this time, she feels confident in the financial system. Now, we should also note that on the note about the tools that regulators have in this situation, the FDIC, after the last financial crisis, made banks go through a process to design what we call living wills, or essentially if a bank were to go belly up, how would its assets get wound down? Now, that's what you can imagine the FDIC is pouring through behind the scenes, trying to separate out the good and the insured assets at Silicon Valley Bank from the bad assets, the underperforming assets, or whatever deposits are uninsured. And then if there's enough to sell the good portfolio of assets, perhaps they might still pursue that path. But that's what regulators are doing behind the scenes, combing through those assets. And they essentially have a roadmap from the bank because of the regulations that were put in place the last time around. Tyler and Kelly.
You know, it's interesting. It takes me back to 2008 when we had the idea of separating the good bank from the bad bank. And in that case, I suspect the differentiation between the good assets and the bad assets may have been a little bit simpler because there was a lot of garbagey mortgage-backed securities in those portfolios. This is a case where, if I'm understanding it correctly, the bad assets were long-dated U.S. Treasury securities, and they were bad because they lost value because interest rates went higher.
Yes, well, certainly there was that big portfolio of U.S. Treasuries that the bank had sold at a $2 billion loss, forcing the bank to sell shares against it to shore up its capital levels. And we're still reporting out exactly what the catalyst was that got the bank to make that sale in the first place. Was it regulators raising questions about the bank's capital levels, or was it the bank itself looking at its own balance sheet and saying, we can't announce another quarter of earnings and have these numbers look the way that they did? That's what we still need to know at this point, Tyler. And certainly, we'll need to know more about what's under the hood and exactly who the bank was lending to, what some of these underperforming loans looked like, and whether they had exposure to other industries, specifically like crypto, where some of that exposure could be a little bit more troubling.
Well, that was the crypto exposure was the one in the other bank there, Silvergate, that liquidated. That certainly is not totally unrelated to this one, but a different case. Kayla, great to see you. Have a good weekend.
Sure. You too.